All right, welcome back to Power Lunch. Are you looking for a place to invest during the tariff turmoil, maybe a safe haven? Well, if so, you might be looking at healthcare, the insurers, and things like big pharma. They are seen by some as being somewhat immune to the trade carnage. But your next guest is here to remind you, not so fast. Jared Holz is senior healthcare strategist at Mizuho Securities America and joins us now. And Jared, I'm glad you came on. You want to talk about the sector in general, but you just put out a note to clients that I think is fascinating. And you write that Pfizer, with the current decline that Pfizer's had, maybe we can throw up a one-year chart of PFE, that the dividend yield is now above the price to earnings multiple on next year's expected earnings. And you note that in your long, illustrious career, you have never seen that happen. What does that, in plain English, what does that mean for our audience?
Brian, great to see you. It's happened. It's been very sparing. I mean, essentially, the street is grading or voting out Pfizer as a near distressed equity based on those characteristics of the dividend yield being ahead of its PE multiple, and that was on 2026 consensus numbers. I just think it is a sign of the times. We're in a very tumultuous era as far as healthcare, pharmaceutical stocks, and companies are fundamentally challenged. I think a lot of investors are aware of that. It does happen from time to time. There have been generic companies where the dividend yield has been above the PE ratio, but it's very uncommon. You almost have to go back to the financial crisis to see a scenario like the one we're in now.
And what's going on with many of these names? And I have been very vocal, and I'm not going to go to it now, but everybody I know, and I've talked to a lot of people, have been sick. I've posted this on Twitter. I know a lot of people that have had strokes, had cancer, currently have cancer, other serious things. Without going, we know that America has, in some ways, a health crisis. These companies are there to help us ostensibly solve that crisis, not just Pfizer, but everybody. Why aren't they getting more investor respect, given that healthcare is 20% of the American economy? It's 1/5 of our entire national output.
Yeah, it's confounding for sure. I mean, I think on one hand, like you said, and I agree, when you kind of boil it down, these are the companies that are saving us. To go back to Pfizer earlier, the vaccine, was incredibly beneficial. There would be few to argue that case. But when you look at the financial models, when you look at the businesses, the way that they're currently set up, you've got generic patent cliffs over the next, call it 5 to 7 years on the medium to long term angle of the company. And then you've got price concessions with the IRA and some of the things that the Biden administration put into place. So you've got pricing degradation over the near term. And then over the, between those two, there's going to be competition. There are going to be other setbacks. So the models just never line up well enough for investors to really have a lot of confidence around. Not to say that you're not going to be able to find a few good ideas here, but the business models themselves just do not lend themselves to long-term viability. I think that's why the sector and the stocks have been pressured for so long.
So, Jared, as people now look at this and say, okay, I wouldn't mind a port in the storm, tell them, and I've been wondering about some of the Medicaid names also, those sold off on this idea that funding was going to be draining out of that space. I'm not sure if you think that's even likely to be the case now. So where's the kind of safe sledding?
Well, I do think managed care, to some extent, the government-centric names like maybe United Healthcare, Elevance, some of these are somewhat safe. I mean, you're insulated from tariffs as U.S.-based companies. An economic slowdown is actually somewhat beneficial. You basically want less utilization. You want less patients through the system. That's how they typically beat numbers. So I do think managed care, even though it's having a good day, there's some companies here that you probably want to own. And it's totally a relative game. I mean, there are so many different variables at play. You're essentially playing a game of hopscotch, trying to jump from one area to the other, whether it's tariffs or drug pricing or other public policy. So I do think some of the stocks that you mentioned at the beginning of the segment are safer. Same with medical device stocks that are more U.S. centric, maybe a Boston Scientific, Edwards Life Sciences, names like that. Again, there's nothing with no hair on it. We're just trying to get to a place where we're selecting stocks with maybe a little bit less risk relative.